Hey guys, what's up? I'm Erin and welcome back to the channel. When it comes to investing and savings, there's a plethora of accounts that you can choose from. And when it comes to your investing dollars, there are certain accounts that you should prioritize first because certain accounts have different tax advantages and different ages on when you can withdraw that money from them. So I wanted to walk through the most common accounts that are available to most people in order to prep for their future and the order in which I would personally fund these accounts. Keep in mind, the order in which I'm going to go over these accounts is preparing for a traditional retirement at traditional retirement age. This is not the most ideal if you are someone who is pursuing FIRE. If you're planning on retiring much earlier than traditional retirement age, this would not be the most ideal situation for you. However, if that is a path you are pursuing and you are interested in a video like that, please let me know in the comments down below and I can absolutely make that type of video. But without further ado, let's jump into a traditional retirement preparation and the accounts I would use to prep for it. Number 1, the 401k. Up to your company's match. The very first thing you want to do is capture your employer's matching contribution. Your employer's matching contribution is literally free money. You do not want to leave that on the table. And every employer sets up their match a little bit different. Some employers match 2%, some employers match all the way up to 6%, and others are somewhere in between. The national average is 4.3%. Of course, the higher the match that an employer is willing to offer, the better for you. After all, that's more free money. Here's how a matching contribution works. Let's say you make $60,000 a year and that your employer offers a 4% match. That means your employer will deposit an additional $2,400 into your IRA, provided that you do the same. Bear in mind that not all matches are calculated the same. With some employers, they do a dollar for dollar match. It's more common to see a 50-cent per dollar match. So in that case, if you had a plan that did a dollar for dollar match, you would have to contribute $2,400 to get your full $2,400 employer match. But if you had a 50-cent on the dollar match, you would have to contribute $4,800 in order to get that full $2,400 match from your employer. So pay attention to your plan. Either way you look at it, that's either a 100% immediate return on your money or a 50% immediate return on your money. I would not pass that up. Now, if you work for the government or a nonprofit organization, the 401k is likely not the plan that's available to you. Instead, you probably have a 403b or a TSP. The good thing to note is they function very similarly to a 401k. If you work for a nonprofit, you likely have a 403b available to you, and the matching contributions are set up by each individual employer, just like the 401k. Now, when it comes to the TSP for government employees, the first 3% of pay that you contribute will be matched on a dollar for dollar basis. The next 2% will be matched at 50 cents on the dollar. No matter what type of plan you have, don't leave free money behind. You want to contribute to capture at the very least up to that match. Number 2, the IRA. Once you've captured your employer's matching contribution in that 401k, now it's time to fund your IRA or your individual retirement account. When it comes to IRAs, there are two varieties. You have the Roth IRA and the traditional IRA. The primary difference between the two is when your dollars are taxed. With a Roth, you put money in that's already been taxed, it grows tax-free, and you can take it out tax-free at retirement age, 59 and a half. It's important to note that Roth IRAs are not subject to required minimum distributions, meaning if you don't want to take your money out of this account in retirement, you don't have to. It can continue to grow. With a traditional IRA, you contribute pre-tax dollars, they grow tax-free, and you pay taxes on the money when you withdraw from this account in retirement. You are eligible to access this money at the age of 59 and a half. However, you do not have to start taking distributions at that point, but this account is subject to required minimum distributions, so you do have to start withdrawing money from this account at the age of 70 and a half. Decide which IRA is best for you. There are income limits to the Roth IRA, limiting those who are eligible to contribute, whereas the traditional IRA does not have these income limitations. The max contributions for both of these IRAs is the same as of the year 2022. If you are under the age of 50, you can contribute $6,000 per year. If you are 50 and over, you are allowed to contribute an additional $1,000 known as the catch-up contribution, so you can contribute $7,000 per year. Step number 3, max out that 401k. Once you've maxed out your IRA, then it's time to circle back to your 401k and consider maxing it out. As of 2022, employees can contribute $20,500 to a 401k, 403b, or TSP. And the bonus, if you're 50 or over, you're able to contribute an additional catch-up contribution of $6,500 per year. If you're keeping track at this point, if you're under the age of 50 and have maxed out both your IRA and your 401k, you've contributed a cool $26,500 plus your employer's match to retirement accounts, which means you are going to be wildly prepared for retirement. With contributions like that, you could expect to achieve millionaire status in just 18 years' time and cross the threshold of $2 million in just 25 years' time. But if you're still interested in saving more because you're a super saver and perhaps you have more accounts available to you, let's continue down the line. Number 4, an HSA. If you have a high deductible health plan, you're likely eligible for an HSA, and HSAs are pretty incredible accounts. If you watch this channel, you know I love the IRA for the double tax benefits. Your money grows tax-free and you get to take it out tax-free. HSAs have triple tax benefits. The contributions you put into an HSA are made with pre-tax dollars, and since they come from your paycheck, it reduces your tax liability. It grows completely tax-free, and then you can take it out completely tax-free. It doesn't get any better than that. As of 2022, the contribution limits for an HSA for individuals is $3,650 and $7,300 for families. HSA dollars are not subject to a use it or lose it situation on an annual basis, meaning that money can stay invested and growing year over year. Also, they are not subject to required minimum distributions, unlike the traditional 401k or IRA. There's no age at which you have to start taking money out of this account. HSAs are intended to cover medical expenses. So long as you take the money out of the account to take care of medical expenses, you are not taxed on those dollars, whether it's during your working years or even after your working years. Remember, you get to keep this account even after you retire. However, once you hit the age of 65, if you want, you are able to take the money out of this account and cover non-medical expenses. There's no penalty at this age, but it is important to note that if you take it out to use it for non-medical expenses, it will be subject to ordinary income tax. But in this sense, this account can serve as sort of a backup retirement account. But if you do use the money for medical related expenses, it's taken out completely tax-free, even in retirement. Only about 22% of employers actually offer an HSA, so they're not as widely available as, say, the 401k or the IRA. But it is worth noting that some employers who offer an HSA actually do offer matching contributions. And if that is the case for your employer, you move this up on the list right behind capturing that match for your 401k. You never want to leave free money on the table. So if there's a match, make sure you capture it. Number 5, a SEP IRA. Now again, this account type doesn't apply to everyone, but if you have a side business or a side hustle, this account applies to you. If you are a self-employed individual and your income is not in any way affiliated with your company that offers like a 401k, you are eligible for a SEP, a self-employed pension. The SEP contribution limits are incredibly generous at 25% of your total net earnings, up to or a maximum of $61,000 per year as of 2022. Money that is contributed to a SEP is done with pre-tax dollars. It grows completely tax-free, and then once you reach retirement age, you get to take that money out, but it is taxed at ordinary income tax rates. Once you reach the age of 59 and a half, you are eligible to take the money out of this account. However, if you take it out prior to that age, it is subject to an early withdrawal penalty of 10%, just like the 401k and the IRA, unless that money is used specifically for specific hardship situations. General rule of thumb is try not to take the money out of these accounts early. You don't want to be hit with that 10% penalty plus the tax penalty. There are some limitations for this SEP account as far as who is eligible and what businesses are eligible. For instance, you have to be at least 21. You have to have worked for the business for the past 3 of 5 years and hit certain compensation limits. So if it is an account you are interested in, I would highly recommend meeting up with a qualified accountant who can help you set it up. By and large, these accounts are available to freelancers, sole proprietors, partnerships, and other business entities. So there is a good chance you qualify, but I still recommend seeking the guidance of a trusted financial advisor when establishing new accounts like this. Number 6, a traditional brokerage account. Finally, after we've exhausted all of those tax-advantaged accounts, we come to the traditional brokerage account. And this would be an account that you open on your own accord with a brokerage house like Vanguard, and you would use it to buy things like index funds, stocks, ETFs, REITs, bonds, etc. The money you invest here is done with post-tax dollars, and you are taxed on an annual basis on any realized gains, which is why it's a good idea to take advantage of tax-efficient investment vehicles like the index fund to help reduce your tax liability. Any withdrawals you take from this account, again, are subject to ordinary taxation. If you held an investment for shorter than a year, it is subject to short-term capital gains tax or your ordinary income tax rate. If you held an investment for longer than a year, then it is subject to long-term capital gains tax, which is slightly less than your short-term capital gains rate or your income tax rate. And while these accounts are not tax-advantaged accounts, they do allow you a place to put your money where you can absolutely access it at any time without any sort of penalty. And depending on your situation, that can be a great perk. Planning your financial future is a big undertaking, and taking advantage of tax-advantaged accounts allows you to maximize your dollars and their growth potential. But it can be a delicate balance because perhaps there's money you need in the near future, maybe in the next 5 to 10 years. So maybe retirement accounts isn't the best place for this money. But if you have money that you don't need until full retirement age, maybe that's 10, 20, 30, 40 years from now, taking advantage of these tax-advantaged accounts is a really great idea. The best place to put your dollars really depends on your personal situation. What stage of life are you at? When do you plan on retiring? What accounts are available to you? What are your personal financial goals? Remember, at the end of the day, finance is personal. This video was brought to you by Skillshare. Are you interested in making a career pivot or leveling up your skills in a current role? Skillshare is a great resource for freelancers and entrepreneurs to keep learning new skills to support your growing side hustle or launch into a totally new career with classes like Starting a Successful Side Hustle with Ali Abdal or the Side Hustle Toolkit, Tips and Tools for Starting and Growing Your Side Hustle with Emma Foles. Remember, if you have a side hustle, you are eligible for a SEP account and you can help save for your retirement and your future. With Skillshare, new premium classes are launched every single week, so there's always something new to discover. And their classes are presented ad-free, so you get to stay in the zone while learning. The first 1,000 of my subscribers to click the link below will get a 1-month free trial of Skillshare. So start exploring today. Well, that's gonna do it for me today, guys. If you got anything at all out of this video, please give it a like. If you're new here, please consider subscribing. Or if you know of anyone who might be interested in this type of content, please consider sharing. I post new videos every single week, so I will see you soon. Have a good one. Bye.